There's $40 trillion in IRAs and 401ks that needs to get passed down to the next generation. Now, I want to talk about how do you inherit an IRA or 401k. You're already dealing with the death of a loved one. It's a very difficult time. And then you got to face these rules the IRS has that are super complicated. So my goal in the video today is to make sure you know how to navigate around the penalties, how to avoid taxes, and then how to properly structure your inherited IRA or 401k. I'm Matt Sorensen. Let's build wealth. All right, I want to break this video down into two sections today. First, I want to talk about your options when you're inheriting an IRA or 401k. Then I want to talk about what are you? Are you a spouse beneficiary or a non-spouse beneficiary? Because the rules are different based on what you are. So first, let's talk about the two options you have. Option one is the bad option, the option I don't want you to do, which is to distribute and drain the account. If you have a loved one that's passed away that has listed you as the beneficiary on the retirement account, after they pass away, you could distribute and drain the whole account out right now. You don't have to be 59 and a half. You could be 40 years old. You inherit an account from parents. You could drain the whole account on day one. Now, if this is a traditional account, you're going to pay taxes on that. There's no early withdrawal penalty. If this is a Roth account, there's no taxes on it, comes out to you, no early withdrawal penalty either. But that would be a foolish decision to drain and distribute the retirement account, because option two is to continue to invest and save and grow that account in a tax deferred manner for you inheriting traditional accounts and a tax free manner for those inheriting Roth accounts. So let's do the smart thing and let's continue to stretch the tax benefits of the IRA or 401k by doing either a spousal rollover or an inherited account. Now I'm going to break those two options down here. We got to get into the two classifications now on inheriting an account. Now I want you to take option two there, the smart option, which is to continue to stretch out the account and invest it. But Congress, in all of their wisdom, decided to make the rules super complicated and change it based on whether you're a spouse of the deceased or whether you're a non-spouse beneficiary. And even if you're a minor child, the rules are a little bit different, but I don't have time to get into that one today. So I just want to focus on the two most common beneficiary scenarios of my spouse has passed away and I'm inheriting their account, or my parents have passed away, or my aunt and uncle, but it's just a non-spouse beneficiary and I'm an adult. So let's go over the first option. Your spouse passes away. Now, the unique thing if you have a spouse pass away is you're able to do what's called a spousal rollover. What that allows you to do is your deceased spouse's traditional IRA or Roth IRA could be rolled over into your traditional IRA or your Roth IRA, or you could create a brand new one. The nice thing about this is now just your IRA or your Roth IRA. It's not an inherited account. It goes under the rules for your age. So if you're 50 years old and you're like, I want to keep investing this thing for another 20, 30 years, and my spouse has passed away, I can just roll it over into an IRA in my name using the spousal rollover rule. Now, this is different from inherited IRAs that non-spouses must do, and I'm going to go over that in just a minute. But the key distinction and benefit here is it just goes into an IRA in your name. And if you already have one, it just can go into your IRA. If it's a Roth IRA, it goes into your Roth IRA. It's super simple and easy. The distribution rules now go based on your age. There's no RMD required unless you're already 73 and you have a traditional IRA. So you get all the benefits of just keeping it simple. It's just an IRA in your name. No early RMD or distribution required. Now, there's one instance where you might be a spouse and say, I actually don't want to do the spousal rollover. For example, let's say that you're 53 years old and your spouse passes away and you're like, man, I need to live on this income. This is a significant asset. It's a significant account. I don't have other assets, but I want to live off of this now. Well, if you do a spousal rollover, you can't touch that money until you're 59 and a half. But if you do an inherited IRA, which you can do, you'll need to distribute the account over a certain period of time, but you can start taking early distributions now from an inherited IRA, because when you do an inherited IRA, which we're going to talk about here in a second a little bit more, but for spouses, if you do an inherited IRA or anyone else, you can take distributions before your age 59 and a half, no early withdrawal penalty. So that would be one situation I can see where a spouse may want to elect not to do a spousal rollover, but instead does an inherited IRA. But most people's goal is going to be, let me just roll it over to an IRA in my name, keep it simple. I continue to grow and invest the account. I don't have to take the money out over time. And when I hit 59 and a half, I can tap it anyways, just like it was an IRA in my own name. All right, now, surprisingly, the spousal rollover is the easy one. Those are your options there. there. I've simplified it a little bit, but that's the essential things you're gonna wanna know. Now let's talk about non-spouse beneficiaries. This is a very common one. Let's say your parents pass away, or a grandparent, or an aunt, or uncle, or friend, or whatever it may be, and now you're inheriting the account, but you're not a spouse. In this scenario, you're called a non-eligible designated beneficiary. That's what the tax code calls it. But what happens here is you're able to take what is called an inherited IRA. You can't roll it into an IRA in your name like you can in a spousal rollover. Instead, it becomes a special type of IRA called an inherited IRA. Under an inherited IRA, you can receive the money from the deceased person's account, whether this is traditional or Roth. There's traditional inherited IRAs or Roth inherited IRAs. But what it allows you to do is continue to invest the money over a 10-year window. You can say, I want to keep investing this. I don't want to distribute it all out. And you get a 10-year window to continue investing the money. Well, why would you want to do that? Well, if it's a Roth account, I get a whole nother 10 years to grow this account. I might have a $300,000 account that I inherit as Roth. If I continue to invest it, even an 8% annual return, I can double the money in 10 years. This can be a $600,000 account, and it'll come out tax-free when I pull it out at the end of 10 years. So same thing with the traditional account. I continue to grow it and I get the tax deferral benefits of the traditional account. So a lot of people like the inherited accounts because they get to continue the tax benefits of the deceased person's account, but it's in an inherited IRA in their name. Now the rule though is a 10-year window that you have to continue to invest and grow the account. Now I want to talk about Roth accounts first. The nice thing about Roth accounts is there's no RMD. If you inherit a Roth IRA from someone, you've got that whole 10-year window to grow and invest the account. But you got to take a distribution at the end in year 10. Now you can distribute money out whenever you want, but the full thing has to be liquidated at year 10. But there's no rule that says you have to take a certain amount every year. The full amount just needs to be distributed by year 10. Now this is where I've said the rules are complicated because now when you get to traditional IRAs, you actually may need to take RMD every year over the 10-year window. And the criteria here of when you may need to take a certain amount over that 10-year window depends on the age of the person who had the IRA account, the traditional IRA, and then passed away. All right, so here's the rule on inheriting a traditional IRA, again, using the inherited IRA account method. If that person who passed away was already at RMD age, which is right now 73, or they were older, when you inherit that account, you have to continue taking RMD. So now I've got a 10-year window, which I can continue to invest that traditional IRA, but I got to take a required minimum distribution every year from that account over the 10-year window, and the whole thing gets distributed by year 10. Now that kind of sucks because it eats into the amount of money I can continue to invest. The nice thing about it is it does chunk up the taxation of it in a traditional account, because remember, when you take a distribution from a traditional IRA, even an inherited traditional IRA, there's no early withdrawal penalty, but it does go into your taxable income. So it is breaking up the taxes on it, but I don't continue to be able to invest the whole amount. It is getting drained over time in that 10-year window in small amounts because you have to take this RMD. Now, let's change the facts here. If the person is not at RMD age at the time they were deceased and you inherit their account, let's say they were 60 years old, you inherit their account. You have that 10-year stretch window, but you do not have to take any RMD over the 10-year window. Instead, you just have to fully distribute that account by year 10. So what I would do in that scenario is I inherit that traditional IRA. I can invest it for 10 years. Don't have to take anything out if I don't want to. Now I can take money out. Let's say at year 3, I'm like, I want to take some money out. You can do that. No penalty. That's going to your taxes, but I have to fully distribute that thing by year 10. So again, the distinction is what is the age of the person who was deceased? Were they in RMD already, which is age 73 right now, or were they not in RMD yet? They were younger than that, in which case you do not have to take RMD. You get the full 10-year window to continue investing the money, but then you have to take the money out entirely at year 10. So one thing I want to be clear about in any of these inherited IRAs I've talked about, whether it's a Roth IRA, a traditional IRA where you have to take RMD every year, a traditional IRA where you get the whole 10-year window that you've inherited, in any of those scenarios, there's no 10% early withdrawal penalty. You can always pull the money out whenever you want. Remember, the traditional account, that does still go into your taxable income, so you will pay taxes on it, but there's no 10% early withdrawal penalty. And that's really just something unique to inherited IRAs specifically. Now remember, if you do a spousal spousal rollover because you're inheriting account from a deceased spouse, in that scenario, it depends on your age and you do have to be 59 and a half. So you want to be careful on the spousal rollover. If you want to access that money, be careful about whether you're 59 and a half and whether you need access to this money immediately or not. Because if you need the money early and you're not 59 and a half yet, you actually may not want to do the spousal rollover, and instead you do what we're talking about now, which is the inherited IRA. Now, as you can see, the rules on this are a little complex, but I hope the video outlined the strategies, the tax benefits, and the savings incentives that are there when inheriting an IRA or 401k. Please go ahead right now, subscribe to my channel. It's free. I'm giving this information for free. It doesn't cost you anything. I've got a lot of content on saving taxes, protecting your assets, building wealth, and growing your retirement. We'll see you next time.